Okay, this is exercise BE 11-6, and it's another calculation of income from net cash flow from operating activities. Okay, so this is something you want to try to make sure you know. Okay, so we start out, they tell us that reports net income of 70 million. If you had retained earnings in here, you would use that 70 million, but right now we'll just do this. We'll just take our statement of cash flows and start out with net income of 70 million, and I'm just going to say 70. Okay, we don't need all those numbers. Included in that number are depreciation expense of 6. So if depreciation debit the depreciation expense, credit the accumulated by 6. If we're crediting this balance sheet account, then we're going to debit the cash T account, okay, by 6. It would be shown as an increase in cash. Okay, one thing down here, loss on the sale equipment of 2. Okay, let's put items not affecting cash. And the first one here is depreciation. And this is this way on just about every cash flow statement you'll ever see. So depreciation expense is 6 million, so we're going to add back 6 million. Okay? Then a loss on the sale of equipment of 2. Now they didn't give us beginning and ending balances or anything like that to reconcile, but any gain or loss on the sale of anything is not going to be a cash gain or loss. It's just a difference between the book value and the cash received. So what we're going to do is take $2 million and add this back. Loss on sale of equipment is 2 million. Okay, then they say records reveal increases in accounts receivable, accounts payable, and inventory. So accounts receivable, okay, accounts payable, and inventory. These are increases. So let's see, accounts receivable went up by 3. Accounts payable went up by 4. That would be a credit. And inventory increased by 5. Okay, so accounts receivable is a debit. I would credit it here. And that would be AR. Inventory was a debit, so I credit it here. Accounts payable is a credit, so I would credit this and then debit the cash T account. All right, so now we can put these in. So far in our statement of cash flows, we've got net income of 70,000. We added back depreciation, and we added back a loss on the sale of equipment. Now for accounts receivable, we're going to say increase in accounts receivable. And you can think of that as these are sales that increased our receivable, but we didn't get the cash for them. So we'd have to reduce our net income by that, okay? So that would be -3. Increase in inventory. And inventory is right here. That's also shown as a credit on our cash T account. So that would be -5. And then finally, increase in accounts payable. That would be a credit, so that would be a debit over here in our cash T account, meaning it would increase. If accounts payable went up, that means that we've got expenses on the income statement that we haven't paid for yet. So we would want to add that back to get from net income on an accrual basis to net income on a cash basis. So this is increase in accounts payable. This would be a positive number. That would be a 4. Okay, so net cash flows. Can't type today. Okay, our net cash flow from operating activities is here. And that's 74,000. That's right. We can put a nice underline here. So a top and a double bottom. Okay, and that should have a $sign also because it's the end of the schedule. Now it's perfect. Okay, all right.